In last week's market update video, I talked about how Friday, the consumer sentiment index was coming out, and it came out. It has been reported. Economists were expecting a reading of 60.0, which was slightly above the historical low back in 1982 that we actually beat this year. So consumer sentiment is not good. So what's consumer sentiment? Very simple. The US government surveys a bunch of consumers and asks them, hey, how do you feel about the economy now, in the future, all these things? Basically says, what is your sentiment on the economy? Okay, what's your spending going to be like? It's been very low. Why? Inflation was high. People started to worry about that. Stocks were getting lower. People were worrying about that. So they're expecting 60. And here's what the reading was. The reading came in at 59.5. So slightly worse than expected, but better than August, but much lower than last September, okay? These are the important aspects to understand. So there has been improvement, but there's still a lot of reluctance out there by consumers about what's going to happen looking forward. Now, you might be sitting there saying, wait a second, unemployment's low. The GDP still feels like it's fine. I still have my job. Remember, GDP is down 2 quarters in a row, which technically is a recession. And also remember that unemployment is a lagging indicator. What does that mean? Unemployment changes later than recessions start. We usually find out we're in a recession months down the road, sometimes even after the recession's even over in and of itself. And then we find that unemployment starts to go higher and higher. But it is understandable that with interest rates doubling in the last year and the Fed raising rates to fight inflation, that people would have a little bit more apprehension about spending money. Hopefully, the good news is you're watching this channel for a good reason. You've sat there and looked. And if you're new to this channel, I'm Paul. I have been teaching value investing for over 10 years now, in the last few years on YouTube. But I want you to remember, just because I or someone else has a YouTube channel does not make us an expert. But what I want you to focus on is watching me currently and my past videos and future videos. I'm very consistent in the way I approach every investment, and my thought process is consistent and logical. I'm not the kind of person who's going to go chase hype and excitement. I look at every investment as the present value of all future cash flow, and my goal is to buy when I see price below my long-term value. I want to remove as much emotion as I can, which is very difficult and impossible to remove all of it. So when it comes to consumer sentiment, what am I doing here? I guarantee that if you watch 4 of my videos, you will walk away knowing more about how to view things, and you'll also walk away saying, hey, I might not agree with this guy and everything, but he is a logical and process-driven person. So when it comes to consumer sentiment, the reason that matters to me so much is that I'm going to look at it as, where's everybody's perception of the economy? Because perception will equate to reality in some fashion. If you believe a recession is coming, you are going to spend less money. That's an absolute fact. And if you're watching this channel, you're probably one of the smarter financial people who lives well within your means and wants to figure out a way to retire safely. And that is awesome. So what I'm going to tell you is, when it comes to all these things we're going to talk about, understand them, know them, but don't make any alarming decisions because of it. You should pick a lifestyle that works for you for the long run. So when I look at this consumer sentiment, it's not for me to go, oh my God, I'm going to stop spending. No, it's for me to sit there and say, okay, I can understand how we might be in a recession right now. Maybe I feel it, maybe I don't. Inflation's high. It's been leveled off for the last few months. These are the good indicators. Now, coming up is the interesting part. This week is a busy week when it comes to what's coming out in the markets. But this is the big one, guys. Good old Fed. One thing, I want to see existing home sales, because there are still people out there who don't believe that these increase in interest rates is affecting home sales. It absolutely is. Rates can't double in 1 year and you not expect people to react. A year and a half ago or so, the average 30-year mortgage was 2.6 or 2.7%. Today, it's closer to 6. In fact, last week at one point, it was over 6%. Guys, we can understand if it took 5 or 6 years for that to happen. It took not even 18 months. That's absolutely going to affect things because people can't take shocks to their costs. Look at inflation. Inflation was up 8.59% in 1 year. You absolutely have to believe that was affecting people's ability to go out there and buy stuff. It absolutely was. Look at car prices. Look at all these things that skyrocketed so much in the last few years. But our good buddy, Jerome Powell, will be announcing this week. What's the announcement? Where are rates going to go now? And there's been a lot of talk based on last month's results that they are looking at another big hike, potentially 1%, which we have not seen since the early 80s. Is that going to happen? I don't know. Am I going to change any decision I make between now and Wednesday in my investments based on that? Absolutely not, and neither should you. If you dollar cost average every month, month in, month out, every quarter, whatever it is, and you have a long way until retirement, your goal should be that this causes markets to fall because you want to keep buying more of the market at a cheaper price. That should always be your goal until you're ready to retire. For those of you who are close to retirement, this could be scary. I get that. I understand that. I'm not in your position, so I can't fully understand it. But my recommendation to you is figure out what the right appropriate market risk for you to be exposed to. Because if you have 100% of your money and you're going to retire in the next 3 to 10 years, you should be looking at this as saying, hey, can I afford for my stocks to go down in half? If you can't afford that right now, you need to reassess. But if you're young, under the age of 50, still 20 plus years away from retirement, don't worry. These ups and downs are going to happen. Go look at the last 20 years. Look at all the things we've experienced in the last 20 years. And we've overcome it all and markets have gone up. Why? Because the U.S. government, the U.S. economy has gotten better over that period of time without even question. So this is the big news. Is the Fed going to raise rates 1%? I think 0.75 is a lock. If I'm wrong, I don't care. It does not affect me. But if 1% happens, I think you'll be hard pressed to not see a big drop in the market. So be ready for that. But again, if you dollar cost average, this should be good news for you. Let markets fall. Allow yourself to buy stocks that you love at cheaper prices. This is the benefit of how you can make money off other people's emotional reactions. This is fine. This will be fine. Historically, the Fed funds rate, going back to 1950 or something like that, the average has been about 4.6%, but the median has been 4.1. So what's the difference? Well, the average includes the early 80s when the rate was 13, 14, 15 plus percent. But the median is 4.1, means half the time it's above 4.1, half the time it's below. So even if people are right and we see 4.5% the next year happening on the Fed funds rate, okay, that's about where it has been in history. And the US economy still did great during those times. And even in the early 80s, it was done for a reason, to curtail inflation. Because at that time, we had stagflation, which was stagnant economic growth with increasing prices. And they had to fight it hard, and they chose to fight it with interest rates. And short term, it caused a lot of pain. But long run, look at how the US economy has grown in the last 40 years. It was the pain we might have needed to see this growth today. This is probably very, very different than what you're hearing from all those pundits out there and all those other people. And that's what I want. I want there to be a different approach to how we look at money. Money should be used as a tool to set yourself up in the future. It shouldn't be used as fear. This is all fear-mongering when you sit there and go, oh my gosh, rates are going up 1%. The world is falling apart. No, it's not. No, it's not. Now, does that mean I'm positive on the short-term outlooks of the market? No. But I'm not going to be here to sit there and say you should change your entire future plan because of a year or two of potentially bad market. I'm going to sit there and show you the positive of it, which is use this as an opportunity to buy stocks cheaper. That's exactly what you want to do. Use all of this. Look at all this. Initial jobless claims. This comes out every single week. Okay, it's going to come out and it's going to be adjusted, et cetera. But here's another one. The U.S. manufacturing PMI. That's going to show us what's the U.S. doing in terms of its manufacturing. Are they making more products? Are we sitting there? Is there demand for more and more products? That's going to be important also for the long run in terms of looking at where the economy is currently. In this market, in any frothy market or down market, what's most important to do in everything you do in life is have margin of safety. You absolutely need to watch this next video where I explain margin of safety and how you can use it to your advantage when you invest. Please subscribe to the channel. Thank you very much for your time.